Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Welcome back. Thanks for tuning in again this week. I am Sarah Larby and you are listening to Where Should I Invest? We've got another great episode today, but before we get into that, I just thought I'd give you guys a little bit of an update. The Airbnb properties that I've had actually have been doing pretty well throughout the pandemic. And I will say that most of the guests that are staying are like 1 to 3 months and the cash flow is going well. So I think there's definitely something to be said about that medium-term stay. Not necessarily the vacationing public from wherever staying for 2, 3, 4 days, but there's definitely need where I am anyways in Burlington, where somebody is selling a house and not moving into another one for a while. And so I've had a lot of inquiries about that and a lot of bookings about that recently, where they're going to stay for 30 days, 60 days, some of them 90 days. And it's nice because you can still charge a premium and you've got some great potential renters that are not going to be lifers. So that's kind of an update on that. And the Lakefield property has closed. I'm working with Harry James on that, as well as Joe from Napa Valley Construction. And I'm super excited about that project, which is essentially a buy, build, rent, refinance, repeat. So technically still a BRRRR, but just on a different scale. So I hired Harry, or I should say I brought him in as a partner, and Joe is coming in to help with the construction. So I'll keep you guys updated on that and how that goes, but I'm excited for that new chapter. Today's guest, let's move on to the podcast. Today's guest is none other than James Knull, who's a realtor and a real estate investor. And we talk about Alberta and the Edmonton markets. And James started out buying houses with secondary suites and then moved on to some multifamily, and now is focused on brand new builds and some infill and everything in between. So quite an exciting conversation that we had. He experienced rapid growth periods and now is being more selective in what he acquires. But he alternates between the Edmonton market and Vancouver. And he's done many joint ventures. He's an active real estate investor and holds about 260 doors. So I'm super excited for you guys to meet James. And don't forget, if you do enjoy the podcast, to leave a rating and review. Thanks so much for tuning in. See you next week. And let's bring in James. James, welcome to the show. How are you?
Hey, good morning. I'm doing fantastic. Love getting the morning started nice and early. I'm in Vancouver today, staying in a beautiful character home Airbnb. This place is about 150 years old in the Kitsilano area. So I always like staying in places that are super unique, and this one does not disappoint.
Very cool. So you're out in Vancouver. Do you reside in Vancouver or do you reside somewhere else?
Well, I split my time between Edmonton and Vancouver. We've got a real estate firm in each city. And so being the one leading the way, I divide up whether I'm in Vancouver or Edmonton based on, which team needs my attention, and just making sure the business is flowing between both provinces.
Awesome. All right. So before we do that, and before we dig into that, let's just take a step back and can you share with the audience how you got started in real estate investing to begin with?
Well, when I was just finishing up university, I was kind of chatting with my dad about what my next plans were. And he said, hey, if you're going to stay at Edmonton, you might as well start picking up some properties because it'll help you later on in life if you buy property a little bit earlier. And so sure enough, I bought a house and rented out the rooms to all my buddies. I had a little bit of a frat house going. And that was kind of my first real foray. We had a great time. And in addition to just having the best time ever living with some of my best friends, I was basically living rent-free because the contributions they were making to the monthly budget allowed me to just live in the house for free. So it was an incredible win-win. And from that experience, I thought, okay, well, why don't I try this with another house? So I ended up buying another one about a year later, and it kind of snowballed from there. I really fell in love with it. I really started liking the financial benefits that it was giving me in my life, and I just kept getting more properties. And after a little while, I wanted to be in the industry so much I got my real estate license, and here we are.
Awesome. So you started scaling, and what does your portfolio look like today? What's the size of your portfolio, and what's your main strategy?
Yeah, that's a good question. My portfolio's close to 260 units these days. The first phase of my investing career, I was buying houses with secondary suites. So I've got, about 20 houses with secondary suites kicking around. The next phase is when I switched into the multifamily residential. So I've got 14 apartment buildings now. And then I kind of went back to the house game, but with brand new houses. So I bought and built a few brand new houses in the mature neighborhoods by kind of like tearing down old houses and putting new ones in. And I found I really like that balance to my portfolio because that more pushing luxury end, brand new inventory attracts a kind of a different tenant profile, and it just balances out the mix in everything I've been holding on to.
Very cool. So over 250 doors. Congratulations. That's awesome. How long have you been, like, how
Thank you.
long ago was it that you actually started? Like, how many years has it been since you've been investing?
Yeah, I bought my first place about 15 years ago now, so it's been a while. It's not like that happened overnight. It's been a slow and steady progression, and just every time a really good deal comes up, I take a look at it and consider it seriously. There were a couple of phases where my objective was just get as many doors as possible. So there were a couple of periods of really rapid growth in there. I know in 2009 I bought a ton of houses. In 2014 and 15 I bought 8 buildings in 2 years. So there were there were a couple of spikes in there, but for the most part nowadays it's progressive. And when I see a really appealing deal, I'll approach it. And I'm in no rush, but if something makes perfect sense, then I can't help but buy it.
Yeah, absolutely. That's awesome. So where are most of these properties? Are they in Edmonton or Vancouver, or are they somewhere else?
Yeah, they're almost all in Edmonton. I've built my portfolio in Edmonton, but I've got a couple of units in Vancouver, and I want to start diversifying out a little bit more in terms of not only types of properties but cities. So I want to pick up maybe a place or two in Victoria, Kelowna, maybe something out in Toronto. Just really diversify locations a bit more because right now it's the majority of the holdings are in Edmonton.
Yeah, I mean, and that's a good point. Just because we're hearing, obviously we're in the pandemic and we're still in the pandemic, and by the time that this airs, we may still be in it as well. However, Edmonton and when I think of Western Canada, there's just different fundamentals and different pros and cons to investing in those markets versus Ontario or Southern Ontario. Can you share maybe some of the pros of investing in a city like Edmonton and maybe some things to watch out for that could be a challenge?
Absolutely. I would say Edmonton as a city, the biggest and most appealing factor is that it's a cash flow city. Um, you can pretty much buy any property in the entire town and rent it out and make cash flow. The prices of properties are relatively low compared to the average rental rates. And so that ratio makes it a great place to get cash flow. We see a ton of our clients from Vancouver redistribute their equity gains from Vancouver into properties in Edmonton so that they can get a little bit of cash flow to supplement their equity growth. Another great benefit of Edmonton is it's a very easy city to do business in. If you want to do renovation projects or BRRR BRR projects where you're flipping to yourself basically, there's availability of good quality contracting and it's not super expensive. In terms of ease of doing business compared to other markets, we don't have land transfer tax. We only have GST. So if you're going to do $100,000 worth of renovations and repairs and maintenance and property management to your portfolio over a couple of year period, you're only paying 5% tax on that service instead of 5% plus 7 or 8 or 9% PST, HST, whatever.
Yeah.
In addition to that, our landlord tenant laws are very beneficial to the landlord. For example, we don't have mandatory pets allowed in our suites. So if you want to run a pet-free environment just to maintain your property at a higher level, that's no problem. Even with things getting a little bit backed up over COVID, our residential tenancy dispute resolution service is very efficient and very fair. So, for example, if somebody doesn't pay rent on the first, you can serve them notice by the second. Usually have a hearing within a month, And as you know, if they haven't paid their rent by the time the hearing happens, then you get a court order and you can have them out of the property within another week or so.
Wow.
So it's, we don't get those horror stories in Alberta where you have that tenant that is working the system that's stuck around for 6 months, 8 months, not paying rent, where the landlord just gets totally taken for a ride. So, those little intangibles all come together to support it being a great cash flow market because, not only do the numbers work on paper, but the mechanics of doing business make sure that you can protect, maintain, and sustain your cash flow really, really well.
So you probably won't have any tenants that are coming in expecting to play the system. Like in Ontario, you hear some horror stories. I mean, there's great tenants, of course, but you hear the horror stories of, one tenant jumping from one property, not paying, just paying first and last and not paying a penny. And then they could be in that place for 6 months, a year, like with the pandemic, obviously the courts are even backed up even more, but that could be a whole 12 to 16 months or so not seeing a penny from your tenant, unfortunately. So I know, one of the things I've always liked about Edmonton in Western Canada, but Edmonton specifically, is the fact that the landlord tenant board, or your version of it out there, is, at least more balanced than it is here in Ontario.
Absolutely. And the thing is, there's always bad apples in every bunch. But, if you have a bad apple in Alberta, it'll affect you for a month or two, not for a year to a year and a half. Mm-hmm. And anytime I hear a horror story, because I'm sure there's some of your listeners who say, "Oh, I have a horror story," I would politely suggest it's because you weren't proactive in registering for a hearing and serving them notice in a timely manner. Because if you're on top of it, the system is not geared to harm the landlord. It's geared to be very, very fair. And it's very cut and dry. If a tenant's not paying, they have to move out.
So that's in Edmonton. I'll tell you, even in Ontario, though, like with the people that will go to the T and do everything to the T, it could still take 6 to 9 months. So it sounds really appealing in Edmonton, as long as you do things correctly or you hire the right paralegal to do your paperwork and you don't listen to the sob stories for too long. Things can happen. Now, obviously there's some downsides, right? I mean, every market has some risks, some challenges, some downsides. What are some things that we should be aware of?
Yeah, that's a good point as well. I would say the downside is that Edmonton has not been, over the last 10 years, an equity growth market. And so, we're here in 2020 selling properties for the same price that people purchased them for in 2010, 2011. So, obviously, everybody wants to buy real estate, not only for great cash flow, but for mortgage pay down, equity growth. Edmonton hasn't had a period of equity growth in quite some time. We basically, over the last 10 years, saw a period of very solid growth in 2014 and 2015. And then in 2015, oil went from, about $100 a barrel back down to 20, which, us being a resource-based economy, that leveled the prices back out. So anybody who bought in 2010 and sold in 2015 did very, very well. Anybody who bought in 2010, held through 2015 and is still holding now has seen, you get your mortgage pay down, and with historically low interest rates, the mortgage pay down is pretty aggressive, but we haven't seen equity gain in quite some time. Now, that could be seen as a pro because, everybody wants to buy low and sell high. Well, Edmonton's been through a low period. At some point, the market's going to grow. All real estate markets grow on a long enough timeline. So, a lot of our clients are just kind of buying in Edmonton, waiting out the slow period for growth. But because we're not seeing aggressive equity growth, the secondary con to that is there's a lot of properties in the city that it's, in my opinion, very dangerous to purchase. In a hot market, you can get away with purchasing properties in C neighborhoods or purchasing properties with challenging tenant profiles, because even if you have difficulty with the tenants or collecting rent, the aggressive equity growth kind of still creates great ROI. Whereas in Edmonton, if you don't have great tenants consistently paying rent, the property is going to be in trouble because you don't have that equity gain to balance out lack of cash flow. So to that end, in Edmonton, you have to be very, very choosy with your properties and your locations, more so than I would say even in other markets, because if you buy a kind of a crummy property with crummy tenant profile in a not so great location, it's going to be incredibly difficult difficult to turn ROI out of that property, because without tenants paying rent, you're not taking advantage of Edmonton's key value proposition.
Yeah, absolutely. So, whereas Ontario, we've held something for 10 years and likely 10 years ago from today, the price doubled, right? So a lot of the stuff, that somebody has bought in Southern Ontario likely doubled in price. And it allows for an easier, in a way, a little bit easier time scaling. Because you can refinance that money out, utilize that for the down payment on the next future house as an example, calculate your cost of servicing that debt from your HELOC into the cash flow. But definitely in Ontario, you're going to get that lift, and it may be easier to recycle your money. But I don't know, because you've got 250 doors, so you clearly have done something. How did you scale up to 250 in Edmonton?
It was a combination of a little bit of refinancing, but also a lot of capital raising and joint venturing. So, when I talk about my portfolio across the board, I own about 38% of it. If you just average out, the properties where I'm 50-50, some of them I'm 25% partner, some of them I'm 100%, they're all my own. So that's been, I'd say, probably the biggest foundational piece to being able to scale, is just collaborating with people, raising that capital, and then purchasing property.
I see. So the JVs. So I just want to go back to Edmonton, just some challenges. What about in a market where, the oil and gas industry is not faring so well? It happens every so often. And in general, like with the vacancy rates and what we've seen in the market. So like looking back at 08 or 09, or looking back at, probably a couple of years ago when there was another issue with oil and gas. Like, what happens to Edmonton? Does it fluctuate much at that point? Is there more vacancy?
Yeah, that's a great question. Edmonton is probably, out of all the cities in Alberta, the most insulated from the oil and gas volatility for a couple of reasons. Number one, we're the government center. So we're the capital city, and there's all of the major and high-paying government jobs are actually in Edmonton. So oil up, oil down, those government jobs are safe jobs. In addition to that, we've got the University of Alberta, which is the biggest university in the province. And there's 50,000 students, give or take, that attend, and about another 30,000 staff, professors, alumni, cleaning staff, building maintenance staff, etc. So there's between the 80,000 people that are at the U of A and another 100,000 or so government staff, about 20% of our population is completely independent. Like, our adult working population is independent of the oil sector. So while oil fluctuations do impact our market, we don't experience those like really hard plummets like Calgary and Fort McMurray tend to, which is good for the stability perspective. The second piece is that after the 2015 oil reduction, a lot of the big companies in Edmonton started repurposing their infrastructure to manufacturing stuff that wasn't just oil field equipment. So we've actually kind of quietly built this really productive manufacturing sector, repurposing a lot of oil infrastructure to manufacture other stuff. So while we're not completely, oil independent, and like losing oil jobs doesn't impact the city, compared to when oil receded in 2007 and 8, right now Alberta really is doing everything it can to position itself so that 30, 40, 50 years from now, we're not a resource province. We're a much more diversified economy. It's in the works. It's that we're definitely not to the maturity phase of that economic shift. But you can see it happening, and it gives me a lot of optimism for, like 20 years from now, I don't think Edmonton's going to be a ghost town, for example.
Right.
So it's, it's definitely not great when we hear bad news from oil. And if there was another oil boom, it would definitely be really, really good for business in the province. But in the meantime, we're being extremely resourceful and figuring out other ways to keep the economy going.
All right. So that's good. And what did the province do throughout CERB? Like, were there some types of payments like in Ontario, throughout just the pandemic? So like in Ontario, we had the CERB. I'm guessing that's Canada wide as well. Like, is that something that tenants had to? Now, how were they in regards to paying rent. So like, for example, in Ontario, there was like no evictions essentially that we could do, right, during those times. Was there something like that that was put in place for Edmonton if a tenant just wasn't paying, chose not to pay, couldn't pay?
Yeah, we had measures that happened over the real heat of the COVID, like March, April, and a little bit into May. So the CRB was a Canadian-wide program. The province of Alberta issued a one-time emergency grant for $1,000 or a couple $1,000 or something like that. We did have a freeze on evictions for a few weeks, maybe a month there, and there were mandated rental deferrals. Now that wasn't free rent; it just said like, hey, if you can't pay until the CERB kicks in, then you have a month where you can log that rent into the following month. In terms of my quote unquote on the street experience, out of all of our units, we maybe had 3 or 4 out of 250 tenants ask for deferrals, and they all got caught back up. So during the initial first hit of the COVID's impact, it didn't really hit us that hard, and a lot of my colleagues, it didn't really hit them that hard. I would say probably the effects that we felt, or that I'm noticing more, was the echo of it, maybe in June, July, where people facing new employment realities and new economic realities started downsizing their living accommodations. So we would see people move out of a 1-bedroom apartment into a 2-bedroom apartment with a friend, or we would see people move out of a 1-bedroom apartment into mom's basement and stuff like that. So we lost a lot of tenants, or had a lot of tenants just for example, we had 2 people in one of our apartment buildings, 1 bedroom and a studio, go after a 2-bedroom. And now instead of paying, for a $800-900 1-bedroom, they're sharing an $1,100 2-bedroom.
Right. Okay. That's good. Now I want to just take a step back and go into, the scale of the portfolio that you've built and the joint venture partners that you have as well. How are you setting these up from a management standpoint?
From a property management standpoint, I've got one property manager who focuses on all of our strictly residential properties, and then a property management firm that does all of our commercial properties. So there's 2 different property management companies just based on the type of asset that they're managing. But for me, it's all about having reliable, trustworthy property managers. I love having a company that specializes in tenant relationships, managing those relationships, ensuring rent gets paid on time, et cetera, et cetera. That's huge for me. In terms of managing the partnerships, our property management companies give us very detailed, very easy to follow financial reports on what tenant movement looks like, et cetera, et cetera. So I just package that information up and put together quarterly financials for the partners and keep them in the loop on what's going on.
All right, awesome. And how are you finding most of your joint ventures? And was it any different today versus when you first started acquiring joint venture partners to scale?
I would say the biggest difference between when I started and now is that lending rules keep evolving and keep becoming more challenging to get mortgages. So there's more complexity, et cetera, to get loans in place, both on the commercial and the residential side. I still remember doing business, and this might sound ridiculous now, but we were getting mortgages for rental properties at 5% down with 40-year amortizations in 2008, 2009. Nice. That was pretty par for the course. That wasn't really a special exception. I remember that in 2007-8, you could buy primary residence at 0% down. And so I bought a couple of primary residents where I put 0% down, stay there for a couple of months, and then buy a second one at 0% down. That doesn't exist now. It's 20% down. The lending, even the vetting. I had a really good job back then. Before I started my career in real estate, I was in the fitness industry, personal trainer, making, back then about $50,000 a year, which in 2008 was pretty good money. And every mortgage I was applying for, all they wanted was a job letter and a pay stub. They weren't looking at my T4s. They weren't looking at, the breadth of stuff that you have to submit nowadays.
Oh, how it's changed. I know it's,
yeah.
You're jumping through a lot more hoops now for sure.
Exactly. And, even just the limits they place on the number of rental property mortgages. I mean, back in the early 2010s, you could get dozens and dozens and dozens of investment property mortgages in your name. It's a little bit more challenging now. So, I mean, we just have to slow it down and be a little more conscientious about how we're getting our financing in order, which partners are going to be signing off on that financing, and think very, very carefully if we're thinking about portfolio growing. Okay, how is this loan going to impact buying a property 4 properties from now? That's ever more important. Every single year it gets more and more important to plan effectively.
Yeah, absolutely. So, and just replan every year. If your goals are changing, but it's good to have a conversation with your mortgage broker once a year. Like, here are my goals. Here's what I still want to do. Here's how, much I want to scale to. Here are my income goals from the rentals, because things change all the time. And like you said, like, it's a great point. You don't want to be just approved for the next one. Like, how many more do you have with the best lenders? And then what's your other option? And then how many more do you have with your trust companies, your credit unions, right? And then, what's the other option after that? So, there's always access to money. It's just the first few that you're going to do are going to be the best rates, the best terms. They're going to, likely be with A lenders. And then at some point you scale it up enough. I mean, this is if you have a T4 income, you scale up enough, you got to go to the trust companies that, ask for more down payment or shorter amortization, or they have higher rates, right? Or you have points as well that you've got to pay up front to borrow that money or get that money loaned on. So, definitely those first few are going to be the easier ones to get. So, for your JVs, I mean, is there a specific vetting process? Like, when, if somebody was looking to join venture and do what you're doing, scale up to 200 plus doors as an example, is there something that they should be looking for when it comes to a joint venture partner that you would suggest that you apply in your business?
Yeah, that's a fantastic question, because, when people are first starting out, they just want to do a deal so bad that they're willing to joint venture with whomever says yes. And that's not always the best person to do a joint venture with. So there is definitely some criteria that you want to have to make sure that partner is going to be the right partner for you moving forward, because, real estate deals are not a quick turnaround. Usually it's at least a 5-year duration, unless it's like a flip. So if you're going to be tied to this person for 5 years and in business with them for 5 years, you kind of want to have a good idea that this person is somebody that you want to do business with. So to that, I typically would say a couple of big scale criteria that I would keep in mind of is, number one, their timeline. I really want to make sure somebody's comfortable with a 5 to 10 year holding period for the real estate, because, you realize the best returns if you hold on to it for a little while. So if they're not comfortable with a medium timeline, then it's probably not going to be a good fit. Another criteria I always try to focus on is how involved that they want to be with the property. I have no problem reporting, giving them high levels of detail, et cetera, but if they have an expectation that, they're helping with the day-to-day management, that's a little bit of a red flag, because, that's the value that I'm bringing together as a managing partner. And if they want to do that work alongside me, at first it sounds pretty good, because you're like, oh yeah, many hands make for light work. But if you have too many cooks in the kitchen, or there's too many people participating in every single decision, it all of a sudden really slows things down, because, even if it's a friendly conversation, every conversation is still a conversation. And if I'm putting in half an hour, 45 minutes a week, or once or twice a week, it adds up. An hour a week for 52 weeks, there's a heck of a lot of stuff I can do with an extra 50 hours a year that isn't just keeping my joint venture in the loop and shooting the breeze with them. So, that's a very important consideration, especially when you project the importance of your time out over a year or 5 years. I mean, gosh, at the end of a 5-year period, that's 250 hours. I guarantee I could find a joint venture partner, find a property, purchase the property, and manage an entire property with another 250 hours over a 5-year period. So I don't want to waste that opportunity with someone that just needs a higher level of engagement than really I think is necessary. And then, the easy one, of course, is like, can they actually financially qualify to be a joint venture partner? But that's kind of a gimme. I think the first two are the additional ones that you really want to pay attention to.
All right. That's some great insights there. Now, at the 5 or 10 year mark, like, do you guys have that discussion? Do you want to hold? Do you want to keep? Do you want to sell? Or is it just an automatic sale? How does that work?
So I usually put into all of our joint venture agreements that the 5-year mark is the trigger of the first sale with an optional to renew. So every time the 5-year mark is coming up, usually by 4.5 months, I'm like having a conversation saying, okay, we're 6 months away from selling. Here's all the numbers. Here's the reality of the situation. We could sell. This is probably what it looks like. We could refinance. This is what it looks like. Or we could just hold. This is what that looks like. Where are you at? Obviously, I'm committed to sell, but I'm perfectly okay hanging on to this property because it's such a good performer. So open to all options, but I just want to give myself some lead time to take that action because, real estate's a slow moving beast sometimes. You can't just do something in a day.
Yeah, absolutely. Have you ever had a situation where an investor needed to get out in, less than 5 years and
Yeah. Yeah, that happens all the time. So one of the clauses I put into my joint venture agreements is what I call the early exit clause. And it's kind of, it goes both ways, but if one partner just absolutely needs to get out for whatever reason, then we have a clause in our agreement saying that the partner that's choosing to stay can buy out the other partner at 75% of present market value. So that applies to our corporate partnerships for large multifamily properties. That applies to the smaller partnerships. If it happens to be a situation where both partners can't proceed, then it can trigger a sale. But typically, it takes 5 years to realize the returns of a property to its maximum potential. So if somebody needs to get out, it's an inconvenience to the remaining partner to have somebody go off plan and kind of create a scenario where that person needs to take action that they weren't able to plan for. So it's just kind of the cost of the inconvenience.
Yeah, absolutely. It's good to have as a discussion up front as well. Like what happens if, you need to get out in 3 years, or you need to get out in 3 years, and it's good to have that upfront discussion. Or, you never know if somebody's going to need the money for whatever, they're going through divorce or, whatever's happening in their lives. So, it's good that you have something like that as a contingency in there so that everybody is kind of aware or is aware of what the outcome would look like.
Yeah, I completely agree. A well-written joint venture agreement really does spell out every single contingency that could happen. Hopefully they don't, but you have to go through some of the unpleasant scenarios of what if somebody passes away or somebody has et cetera, et cetera. All kinds of crazy stuff can happen. And if it's in writing and you agree on how to deal with it while everything is, just at the start and in good standing, then it makes it much easier to deal with difficult situations if they ever come up.
Yeah, absolutely. Okay. So, you're in Edmonton, doesn't have a whole lot of upside in terms of equity appreciation, but you have the mortgage pay down, of course, and you have the cash flow. How do you essentially give that out? Is it quarterly? Is it monthly? Like when does the cash flow payout happen?
Great question. It depends partnership to partnership. The shortest duration that we have is a quarterly payout. And then I have several partnerships where we do an annual payout. It depends on the partnership and what their priorities are. If somebody's intending to use that cash flow to support their lifestyle, a more frequent duration makes sense. For people that are in it for all, we've got a couple of partnerships where we accumulate the cash flow and we actually put it towards a lump sum principal pay down to accelerate the mortgage pay down because it's, a longer term hold, and the quicker we can accelerate the pay down, the better our returns are because we're paying less interest to the bank. So, and everything in between. But I would say, usually quarterly and annual are my two most typical cash flow payout periods.
Awesome. So you are also a realtor. So if somebody is interested in the Edmonton market, are there like pockets to avoid? Are there pockets that you're like, this is really good for, the long term, this is really good for Burr? Like, are there, every town or every province has some areas that are doing better, right? Like what about in Edmonton?
Absolutely. Edmonton's a pretty darn big city. We've got 1 million people and there's pockets all over the place that make sense for different strategies. I would say probably my favorite area would be in the West End in the Jasper Place area. We've got an LRT, which is like a metro line that's under construction and planned to go through the area over the next 5 years. So we're already seeing a lot of equity growth in the area, even if when the market's flat, values are going up. Lots of activity, lots of reconstruction, redevelopment, infill properties. It's a good place for a 5 to 10 year timeline. there's tons of other areas in the city. One of the things that we do have on our website for anybody that wants to check it out is I've actually created an interactive map, which is the entire Edmonton greater metropolitan area. And you can just click on a different district, and then a little window will pop up with a detailed summary of what that neighborhood does from an investor's perspective. So if anybody wants to take a little gander at it, it's on our website, easy to use. Just click the neighborhood and then a summary pops up and talks about it from an investor's perspective.
Awesome. What's the website?
It's www.mogulrg.com, and then head to the market intelligence section of the website.
Very cool. Awesome. Well, thanks for that. So the next part of the podcast is our lightning round. So I'm going to ask you a series of 5 questions. You're going to give us the first answer that comes to mind. Are you ready?
I'm ready.
All right. Question number 1. What is your favorite real estate investing book?
97 Tips for Real Estate Investors by the legend himself, Don Campbell.
Yeah, great book. I have it right behind me.
Awesome.
All right. So number 2, I don't know if you are a podcast listener, but if you are, what is your favorite real estate or business or podcast in general?
You know what? My guy's Grant Cardone. I love his intense American way of just getting things done. So we listen to a lot of Grant Cardone at the office. I use it for a lot of training. And then, part of what we do is the joke in the office is we translate it from American to Canadian, because in Canada, you have to be a little more polite and a little bit less pushy, but the fundamentals of how he does things are just totally in alignment with how we like to make our sales happen.
Awesome. Number 3, aside from real estate, being a realtor, what do you do for fun?
In the winter, I ski all the time. I'm out in the West Coast, all the mountains, at least 30 or 40 days on the mountain during the season. And then in the summer, I still like going down the mountains. I just go down them on a mountain bike. So
nice.
Basically, yeah, all year round, going down the side of a mountain as fast as I can on some kind of piece of sporting equipment.
All right, cool. Number 4, if you lost all of your assets and all of your income tomorrow, how would you start again?
The cool thing about starting over is you don't lose the experience and the know-how. So I think what it's taken me 15 years to accomplish, I probably could accomplish in about 5 if I had started over, which is really encouraging. So, I would start from square one, and the first thing I would do would be to try to create income producing opportunities. So things like flips to build up enough equity to start getting holding opportunities. The real estate practice, again, I know how to be a very successful realtor. So even if that got zeroed, I could be selling houses again right away. So it's pretty encouraging. I don't think I would do anything too different. The strategies would be a little bit different, but it would be income first and then holding second, I guess, is the quick answer.
All right, awesome. And last question of the lightning round, number 5. If somebody has $50,000 and they want to get started, how would you recommend they spend it?
Oh gosh, that's a tricky one, because it's that answer is completely dependent on what their outcome is. Different people have different goals, but let's assume it's a younger person with lots of time on their hands. I would say use that money to do something that's income generating, be it wholesaling, flipping, assignments, something where you can put in your blood, sweat, tears, and hard work and effort, and turn that $50,000 into $100,000. Because in today's real estate market, $50,000 isn't really a heck of a lot of money. So the first thing you want to do is start multiplying it with your effort. And if you've got time and you got energy, that can translate into returns.
Absolutely. Awesome. James, where can my listeners reach out and find out more about you?
I would say we're very dialed in on Facebook. So look me up on Facebook. That's our main social media platform. So James J. Knull on Facebook. I'm sure my name's going to be in the description of the podcast. And our website. Again, it's www.mogulrg.com. That's our company, Mogul Real Estate Group. One of those 2 ways, you're going to get all kinds of great information.
All right. And your last name is spelled Knull.
That's right, yeah.
Awesome. All right. And I always ask this at the end. Do you have any final last words of advice for the listeners?
I would say go for it. The thing about real estate is it can be difficult and it can be scary, but at some point you have to take action and, educate yourself as much as you can, but be very careful spending. If somebody has $50,000, if you spend all $50,000 on fancy courses and coaching and have $0 to spend on real estate, you've done something wrong. Educate yourself and get competent, but also get going. Spend that money on real estate.
Awesome advice. Thank you so much for being on the show. It was a pleasure talking to you.
Awesome. Thank you.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?